welcome back, and I think we have finished about 3 weeks and continuing from where we left in the last session. What we were actually doing in the last session was we were trying to go behind what is called as your P&L and balance sheet. You sort of talked about, we talked about in the earlier classes week 1 and week 2, and in the last class we were trying to see how does that recording process take place. Finally, it ends up in what you call it as a P&L and balance sheet, but to get into that P&L and balance sheet, what is the process, what is the basic, what you call it as typically when we say bookkeeping, etc., recording of the transaction, when the transaction happens or when the transaction takes place, how is the transaction recorded, number 1, and number 2 is after that how is it converted or how does it become a P&L and a balance sheet. That is what basically we looked at in the last class. We just give you a bird's eye view of the whole thing. Today what we will try and do is we will try and take up a series of transactions out there. I have given you a series of transactions out there which you can see, that is for week 4, please use this. Now we will look at a series of transactions, we will take these transactions, and what we will do try and do is we will go the typical accountant's way. When I say typical accountant's way, we will start recording each of these transactions, as I said in the last class, in a book called journal. Then it moves to the next consolidation of these accounts, that is what we call it as a typically the ledger, and then we move into preparing what is called as the profit and loss statement and a balance sheet out there. We will take you through the entire process for this small list of transactions what I have taken. I think we have got about 25 to 30 transactions out there, we have got roughly about 27 transactions out there, and we will take these 27 transactions and go through it in a sequential form. Now first and foremost what we will do is we will take each of these transactions and let us pass the journal entry as of now. Once we finish the journal entry for all these transactions, then let us get into what is called as preparing the ledger account and so on and so forth as we go along. Now let us do the journal entry. Let me start with that. Let us read the first transaction out here. If you look at, it says from the following transactions of XYZ Nadkarni and Co, you are required to pass the what do you call it as the necessary journal entries, prepare the ledger account, prepare the P&L and the balance sheet, and then all figures are given in INR, that is Indian rupee out there. Let us take the first transaction. It says that Nadkarni commenced the business with the capital of 10,000 INR, 10,000 rupees. Now when we talked about, I talked about accounting itself, there are 3 basic principles which we use for accounting normally for every transaction, that is we classify this transaction into 3 basic aspects. One of the basic aspect is what we typically call it as what we say is it either an asset or a liability. The second thing, second aspect what we call it as, we classify it as whether it is an expenditure or an income. Third basic aspect how we classify is basically when we say it is on what is called as related to an individual, entity, etc. These 3, now what they say is this is what we call it as, we apply what is called as a typical accountants will apply what is called as a real account principle out here. For this they look at what is called as your basically for the income, expenditure, etc. out there, they will apply what is called as a nominal account principle. Now for an individual entity they apply what is called as a personal account principle. Now what does it say? It says that whenever it pertains to any of these, that is whenever it pertains to an aspect in real account, that is an asset or a liability, we always say debit what comes in, we always say credit what goes out. That is, if an asset is coming into the company, we debit it. if something is asset is going out of the company, what do? We credit it out there. Let us look at continue this. For example, if I look at what you call it as the next aspect, what I said in this particular case, if I see that it is related to income and expenditure. When it is related to income and expenditure, what happens? It says that debit all incomes, debit all expenditure and losses, and basically what we say is credit all income and gains. We normally say that debit all expenditure and or losses and credit all income and or gains. The third basic aspect in this particular in this particular whatever recording of the transaction, what we follow is a personal account principle. What you call it as, it is related to individual or an entity. We say debit the, we will say again debit and credit out. Here when we talk about, we normally say that debit the receiver, credit the giver. The person who is giving the credit, person who is giving that particular in the transaction, who is the giver in the transaction, credit the giver and debit the receiver. Let us keep these principles in mind and let us see, try and see if we can journalize these transactions first and foremost. Then let us look at the ledger and so on and so forth out here. Now, if I have to say that, if I have to continue on this, in the first what do you call it as, if you see the first transaction out here, it says Nadkarni commenced a business with a capital of rupees 10,000. You can add multiple zeros. All these zeros are in thousands out here. You can actually do that. Now, in this, if I look at it in this particular case, what happens? Nadkarni commenced a business. Now, what happens in this transaction? Now, there is something, there are two things out here. That is, one is, as far as look at it only from the point of view of the business. Do not look at it from any other point, look at it from the point of view of the business, because you are preparing the financial statements for the business out here. When you are preparing the financial statements for the business, you have to look at it from the business point of view. If you look at it from the business point of view, let us say you take it like this. He has commenced business with a cash of, by what do you call it as, commenced business with a capital of 10,000. That means, as far as a business is concerned, you go back to your asset and liability principle, there is something which is coming inside the business. What is coming inside the business? There is cash that is coming inside the business. The second aspect of it, what is happening because of that? There is cash that is coming inside the business, that is very good, but at the same time you also owe that money to Nadkarni, that is the company as such is a separate entity. Go back to the entity concept what we talked about. The entity also owes that money back to the person who has contributed at the time of dissolution. Now, what is cash? Cash is coming into the company. What is cash? Cash, as we know, is basically nothing but what you call it as an asset out there. When it is an asset, what happens? Debit what comes in. That is real account principle. In the process, what do I do out here? I will say cash account debited rupees 10,000 out here, and then what happens? Is capital, if a capital is it, when I say somebody has given you capital, there is an asset, there is something is when who has contributed that capital. In this particular case, cash has come in, perfectly all right. Now, who has given this cash? Nadkarni has given this cash. Now, when Nadkarni has given this cash, what happens? The principle, what is the principle you apply? You apply what is called as this personal account principle out here. When I apply the personal account principle, what happens? Debit the receiver, credit the giver. Who is giving that cash? Nadkarni is giving that cash. So, basically what I do is, in this particular case, I will say to Nadkarni's capital account. Credited 10,000 rupees. Again, take this transaction. Let me specify. It says that Nadkarni commenced business with a capital of 10,000. His company is incorporated. Business, as far as the business is concerned, what has happened? Cash has come into the business. Go back to what we did in the initial class when we sort of recorded the P&L and balance sheet, what happened? Moment cash comes into the business, the asset increases. Now, when asset increases, what is an cash? Cash is basically an asset out there. When there is an asset that is increasing, now what is the principle under which this basic asset falls? If the principle under which this basic asset falls is real account principle, which says that debit what comes in. What is coming in? Cash is coming in. So, what have I done? Cash account debited 10,000. And then what happens? Now, question is, debit comes in, debit what comes in, credit what goes out. Is there anything going out? Nothing. Okay. What is the next aspect? Is there anything going out? There is nothing going out there. What is the next aspect out here? Now, somebody can say personal account principle. Debit all expenditure and losses. Is there an expenditure or a loss? There is no expenditure or a loss. Credit all income and gain. Is there an income or a gain? No, he has contributed capital. It is not profit. It is not gain. So, there is nothing. Then what is the other one? Nominal account principle. What does nominal account principle say? Debit the receiver. Is there somebody receiving it? No. What is it? Somebody is basically giving that cash to you. When somebody is basically giving that cash to you, what happens in this particular case is, you will say, who is giving that particular cash to you? Nadkarni is giving that cash to you. So, in the first one, in the first part of this particular transaction is debit what comes in, cash has come in, I have debited. Second part of the transaction pertains to personal part of it, that is somebody is giving me that cash. So, credit the giver out there, that is what basically I have done out there. Now, let us look at the second transaction. If there is a question, we will come back again. Now, if I have to look at the second transaction out here, it says deposited money in the bank, deposited in the bank the 3000 rupees out there. Now, what happens when you deposit money in the bank, that is your own bank? It is in this particular case, let me even qualify this particular statement. It says deposited money in your own account in the bank. It is not somebody else's account, you are depositing money in your own account. That is some extension of that which is missed out. You can record it as deposited money in the company's account. You can write it as deposited money in the company's account rupees 3000, perfectly all right. Now, how will that statement read out here? If I have to look at moment you deposit money, what is happening to your cash? Cash is going out of the business, yes or no? So, what is happening to your asset? Asset is reducing, yes or no? Yes. When asset is reducing, cash is going out of the business. What is happening? What is the principle that comes in? Debit what comes in, credit what goes out. What is going out? Cash is going out. I will say cash account is basically credited rupees 3000. Now, the next aspect out here is debit what comes in. What is cash is going out, perfectly all right. Is there anything coming in? Yes, what is coming in? Your money is getting deposited in your account in the bank, and what is called as another asset is coming to you, that is cash is an asset which is going out, another asset which is coming in is in the form of a bank account. The bank balance is yours, you own it, the bank account is coming in, cash is going out. So, one asset is going out, another asset is coming in. Debit what comes in, what is coming in, bank account is coming in, cash account, cash is going out there, and then this transaction is basically complete out there. Am I with you on this? Now, let me sort of move to the third basic transaction out there. Any doubt? Again, I will sort of look at, I will do one thing, I will quickly do a recap of this. Now that I have done two transactions, let me quickly do a recap of this. If I have to do a quick recap of this, it says that we classify all our transactions into three broad categories. First broad category is related to your assets and liabilities, and we call it as a real account principle. Anything that comes under that is what we call it as a real account principle. The second broad category is related to only your income and expenditures. Income, losses, expenditure and gains, all these four put together. We classify that under a group what is called as nominal. Third classification is related to what is called as non-living entities or living entities, that is individuals, enterprises, etc., etc. So, we classify that basically as what you call it as a group of personal account group out there, and each of it has a basic principle. The basic principle is, if I look at real account, what happens in this case, asset and liability, we say debit what comes in, credit what goes out. We will say when we talk about income, expenditure and losses, debit all expenditures and losses, credit all incomes and gains. The third basic aspect in this particular case, if we look at in out here, is on the personal account principle out here. We say debit the receiver, fellow who is receiving, debit him, credit what is called as the giver of that particular benefit to you. So, in the same principle out there, we look at what you call it as this particular transaction in this this particular transaction out here. When we look at this particular transaction, we said that first he started business with a capital. As far as the business is concerned, please note I am doing this only from the point of view of an enterprise, not from any other point of view, only from the point of view of an enterprise. If I have to look at it from the point of view of an enterprise, as far as an enterprise is concerned, what has happened in the first thing, when somebody contributes money and the form of capital, business is concerned, cash is coming into the business. When cash comes into the business, what is cash? Cash is an asset. What happens? What is the principle? Real account principle. What is the real account principle? Debit what comes in. I have debited cash, over. Then there is somebody who is giving me cash. Who is that guy who is giving me cash? There is Natkarni who is giving his cash, who is giving the cash in the form of capital, perfectly all right. So, what happens? Natkarni, moment the word Natkarni comes in, it basically is related to an individual, that is a personal account principle. Moment we look at personal account principle, then what happens? Natkarni, that is debit the receiver, credit the giver, who is giving the credit? Natkarni is giving the credit. So, Natkarni's capital account is basically credited in the process. As I said, every transaction will have two basic aspects, minimum 2 accounts and 2 basic aspects. What I said in class 1, continues. So, here are the 2 basic aspects out here. Now, how does this translate to my P&L? We will look at it as we go along. You can even visualize right now based on the initial classes what happened. What we did, you could visualize, that is, you would visualize that it will go into the balance sheet cash as an asset 10,000, and then in the liability plus capital, Natkarni is capital of 10,000, and then what happens? Your balance sheet is basically balanced, there is no effect on your P&L as of now in the process. Let us look at the second transaction. It says that deposited money in the bank to the extent of about $3,000. When you have deposited money in the bank to the extent of $3,000, what happens? You have deposited money in your own account. There is a cash which has gone out of the business. Debit what comes in, credit what goes out. I credited cash because cash has gone out of the business. The next aspect, debit what comes in. What is coming in? Your bank passbook is coming in with what is called as an entry, which says you have deposited 3,000 and you own the 3,000. So, what have I done? Bank account debited out there in the process. Debit what comes in. This is entire thing of this transaction is both related to an asset, rests only within what you call it as the real account. Now, visualize in the balance sheet and P&L. What happens? The cash which was 10,000 gets split into cash 7,000, and the next aspect in that balance sheet on the asset side will be bank 3,000. Your balance sheet is still balanced in the process out there. Am I with you on this? Shall we go along? Shall we go to the third transaction out here? If I have to see the third transaction out here, bought goods from E engineer. I have just arbitrarily given out there, bought goods from E engineer rupees 2,000. You can add multiple zeros to it, that is 2,000, all these are in the multiple zeros out there. When you have bought goods from E engineer, unless, and normally in accounting I have already I have also indicated to you guys that unless until otherwise specified, I repeat, unless until otherwise specified, all transactions will always be on credit. Unless until otherwise specified, transactions will always be on credit. it will not be on cash. If it is on cash, there will be a specific mention saying that the transaction is based on cash out there. In this case, what has happened? Bought goods from E-engineer. When you buy goods, what is happening? There is what is called as a purchase that is happening. When there is a purchase that is happening, what is happening? Goods are coming into your factory. When goods are coming into your factory, what is happening? There is an enhancement of an asset. There is an asset which is increasing, an asset is coming in. So, when asset is coming in, what happened? Debit what comes in. So, what is coming in? There is goods that is coming in, normally we will say purchases. Account debited. What is the amount? Amount in this particular case is $2000, 2000 INR, 2000 rupees. Is there anything going out? There is nothing going out. But is there an expenditure? So, that is real account is over. Is there an expenditure, income, loss, gain? No, there is only a purchase, there is no gain or there is no profit as of now. Now, next personal account, debit the receiver. Is there anybody giving this? There is no cash that has gone out, please not. Is there anybody giving it? Yes, E-engineer is giving it to you. E-engineer is giving it to you, that is, he is giving the goods to you, he is giving it on credit. Debit the receiver, credit the giver. Who is giving it? E-engineer is giving it. That is, normally we will say creditors. In this particular bracket, I will write E-engineer. I repeat, if we look at it in this particular case, we see that what has happened? There is a purchase that has happened. When there is a purchase that has happened, what is happening? Goods are coming in. Goods are coming in means asset is increasing. Moment asset is increasing, what is the principle? Debit what comes in. That is what I have done here. Second, is there a cash? Have you paid cash? No, you have not paid cash. There is somebody who has sold it on credit. Who is that fellow who sold it on credit? Entity or an individual? Moment entity or an individual, then it goes to personal account principle. Personal account principle, what it says? Debit the receiver, credit the giver. Who is giving the credit? E-engineer is giving the credit. Normally, they are all called as creditors, as we said. So, it is 2000. Visualize it back in the balance sheet. What happens? Moment I do this transaction, on the asset side, my asset will increase, that is stock in trade or what is called as opening stock or purchases, that is basically stock will increase by 2000. On the credit side, what will happen? My creditors will also increase by 2000. Am I with you on this? Asset and liability increasing, the balance sheet will automatically be balancing out in the process. Am I with you on this? Now, shall we move on? We will move ahead, we will move ahead, we will move to the next transaction out there. The next transaction, if I have to look at, it says that sold goods to V. Raghavan for cash rupees 700. Moment there is a sale, what is happening? There is a goods which is leaving your company. That is, there is an asset which is getting out of your company. Am I with you on this? Moment an asset which is leaving the company, what is the principle? Debit what comes in, credit what goes out. What is going out? Goods are going out of your company. When goods are going out of your company, let me say that is what is called as, I will have to credit the basic goods out here, goods are going out of the company. Normally what happens is, we will write sales basically in this particular case, goods are going out of your company, that is I credit the amount basically in this particular case is 700. Now, what is happening? You have sold goods, goods have gone, you credit, debit what comes in, credit what goes out. What is there anything coming in? Yes, there is something coming in, cash is coming in. Somebody can argue, it is not the cash, it is the giver. Who is giving? That is Raghavan. Raghavan should be credited or Raghavan's account should be credited. Now, moment you have received cash from Raghavan, are you worried about whether Raghavan has given cash or somebody else has given cash? As far as you have sold goods, you have got the money, you are not bothered about who is the customer to whom you have sold. When is it that you are bothered to whom you have sold? You are bothered to whom you have sold only when that fellow has to pay you the money. that is where he is giving that is where you are basically giving the what is called a credit to him, that is unless he has to pay you, you are not bothered. If he has paid, you are not bothered to whom you have given the money. So, once you have collected the cash, what is there are two aspects in this transaction. What is happening? Goods going out on one side, cash coming in on one side. From whom it has come, I do not care. He might have given a check, I might have got the cash from the bank, anything. Cash has come in, goods has gone out. One asset has gone out, another asset has come in. Debit what comes in this particular case, the what aspect, the asset that has come in this case is basically cash account that has come in this particular case. So, cash has come in, debit what comes in, credit what goes out in this particular case. So, I have debited what is come in, credited what has gone out in this particular case. It says, you might say Raghavan out there because the question says Raghavan. I am not worried once he has paid. Do you just imagine a situation? You go to a shop, normal a kirana store, and buy some whatever your basic daily need. You pay cash and buy it. Is the customer is the owner of the shop really bothered to whom is he selling? As long as he has received the cash, he does not even worry about it. For him, transaction is a done deal. Suppose you say, I stay round the street, he knows you, and you stay down the street and you are buying it on credit, then what will you do? Madam, tell me, or sir, please tell me your name, and then he will have a register, he will enter your name, only then he is bothered, otherwise he is not there, the transaction is not complete. Here transaction is complete in the process, that is the deal is over, after that he is not worried. So, debit what is coming in, credit what is going out. In this case, I have debited what is called as cash, in this case I have credited what is called as sales in this particular thing. One can argue, sir, supposing he had not paid me completely in cash, he had paid 50% in cash, then what happens? Well, that is a good question. Then what happens? If he has paid 50% in cash, then I would say, what is the cash you have got in? Cash I have got in this particular case is basically only about 350 in this particular case. If I have got received cash, half of cash, then I have received only $350 in cash. Then what happens the other 50%? Other 50% he still owes me. Debit the receiver, credit the giver out there. Who is receiving the credit from me? Raghavan is receiving the credit from me. That is what is called as debit the receiver. Who is receiving? I am giving credit. Please look at it from your company's point of view. From your company's point of view, you are giving that basically credit to him. Debit the receiver. Who is receiving the credit? Benefit of that credit. The benefit of that credit is received by Raghavan. That is what we call it as in accounting, we call it as debtors out there, debtors account debited, another 350. Your credit account remains exactly the same, that does not change, because basically why it does not change? Because that is the amount of goods to which, that is the amount to extent to which goods have basically gone out of your company out there. Am I with you on this?